What if I told you the biggest retirement crisis in America isn't coming? It's already here, and it's been engineered in plain sight. You may think retirement is a simple math problem: save enough, invest enough, work long enough. But here's the truth: the U.S. economy quietly depends on you not retiring. At least, not until you're too old to stop working. Let's rewind. Picture the mid 20th century when the idea of retirement exploded into American life. Companies bragged about pension plans. Workers expected a gold watch and a guaranteed income for life. It felt like progress, a reward for decades of labor. But wait, that's not the whole story. Those pensions weren't gifts. They were part of a system built on booming birth rates, rising wages, and long-term corporate loyalty. A perfect triangle that wouldn't last. By the 1970s, everything began to crack. Inflation hit double digits. Global competition squeezed profits, and companies discovered a brutal truth: lifetime pensions were bleeding them dry. So they searched for an escape hatch, and they found one. Enter the 401k, a tiny section of the tax code never meant to replace pensions. But corporate America seized it like a lifeline. Suddenly, your retirement wasn't a promise. It was your problem. And here's where the story shifts. Because once retirement became individual, the government and the financial industry realized something. An aging population leaving the workforce was bad for business. Fewer workers meant slower growth. More retirees meant heavier Social Security costs. And the entire system, built on consumption, debt, and constant economic expansion, started to wobble. So policies shifted. Quietly, subtly, and always with a smile. First came the goalpost moves. The Social Security full retirement age climbed from 65 to 67. Then came decades of stagnant wages that made saving almost impossible. Employers cut benefits, healthcare costs soared, and the idea of retiring at 60 became a fantasy. The message grew clearer. Stay in the labor force. Keep producing. Keep consuming. Keep paying in. But here's the twist you rarely hear. The U.S. economy truly depends on older workers more than ever. Not because they're the most productive, but because they're the most profitable. Think about it. Older Americans spend more on healthcare, housing, insurance. They keep money moving. They delay drawing full benefits, and by working longer, they reduce the pressure on Social Security, Medicare, and federal budgets. In other words, the system wins when you work until you're worn out. But let's zoom in on everyday life. Imagine someone born in 1965. They watch their parents retire at 62 with a pension. But for them, they've lived through 3 recessions, the collapse of employer benefits, and a financial crisis that wiped out trillions in retirement savings. They were told to invest in markets that swing like a carnival ride. And every time the system falters, the advice is the same: work a little longer. This isn't a conspiracy. It's a chain reaction. Economic forces shaping personal lives. And it's been hiding in plain sight for decades. But here's where the tension really spikes. The U.S. is facing the largest wave of retirees in its history as the baby boomers exit the workforce. And instead of preparing to support that wave, policymakers are doubling down on one strategy: convincing people to delay retirement as long as possible. From tax incentives that favor working seniors, to messaging that reframes retirement as old-fashioned, to corporate policies that quietly eliminate early retirement options, the pattern is unmistakable. So ask yourself, is this simply economics? Or are we redefining the very idea of retirement because the system can't survive without your labor? Before we go further, I want to hear from you. Leave a comment. What was the most important lesson you learned about retirement growing up? Because that early message often shapes how we understand the system today. Now, back to our story, because the next twist is even more shocking. The U.S. economy isn't just reacting to demographic change. In many ways, It's engineered its dependence on older workers. And the institutions we trust, banks, investment firms, even the federal government, have built long-term strategies around keeping you in the workforce. But how did we get from retire at 60 to retire whenever your body gives up? And what's the real cost of this shift for you, your family, and the future of work itself? That answer goes deeper than you think. And it starts with the financial pressure points politicians never talk about. Mini cliffhanger, end of part 1. Let's pull back the curtain on the biggest pressure point of all, Social Security. You may think it's a retirement program, but here's the truth. Social Security is a cash flow engine. It works only when millions of people are paying in and fewer people are taking out. For decades, that balance held. But as birth rates fell and life expectancy increased, the math stopped adding up. Here's the part few Americans realize. Social Security's long-term stability quietly depends on people working later in life. Not because officials enjoy raising the retirement age, but because they can't afford not to. When you delay benefits, whether by choice or because you can't afford to stop working, the system saves billions. Every year the full retirement age creeps upward, the government buys more time, and this creates a domino effect. When Social Security nudges you to retire later, employers adjust expectations. Companies delay handing out benefits. Younger workers wait longer for promotions, and the entire labor market shifts upward like a conveyor belt moving just a little slower each year. But let's go deeper. In the 1980s and 1990s, something else changed. The financial industry exploded. Mutual funds, index funds, target date funds, suddenly, retirement planning became a trillion-dollar business. And those trillions weren't built on early retirement. They were built on long-term contributions, decades of fees, and workers staying invested far longer than their grandparents ever did. Think of it like a gym membership. A gym doesn't make money when you stop showing up. It makes money when you sign up and keep paying, even if you rarely set foot inside. The retirement industry works the same way. The longer you stay in the game, the more they earn on your savings. Retirement at 55? Not profitable. Retirement at 70? Extremely profitable. But wait, that's still not the whole story. In the early 2000s, the U.S. faced another demographic shift. As the baby boomers began inching toward retirement, economists projected a massive reduction in the workforce. Fewer workers meant slower growth. Slower growth meant less corporate profit. And less profit meant weaker stock markets. The very markets Americans were now relying on for retirement. So what happened? The U.S. doubled down on a strategy that rarely gets discussed, keeping older Americans employed longer to stabilize economic growth. And it worked, at least on paper. Workforce participation for Americans over 65 reached the highest point in 60 years. Older workers became a critical pillar in the economy, especially during the years after the 2008 financial crisis. But there's a catch. Older workers didn't stay in the labor force because they wanted to. Surveys show the majority stayed because they had to. Their savings had been wiped out. Their home values had plummeted. And healthcare costs, especially premiums and deductibles, kept climbing. The system essentially told them, you can stop working whenever you want, as long as you can afford to starve. Now zoom into the 2010s. The gig economy exploded. Companies discovered something profitable. Older workers often make ideal gig workers. They're reliable, they're experienced, and they're willing to accept lower wages because they're supplementing retirement income that was never enough to begin with. A perfect storm. But here's the twist most people never notice. The U.S. tax code rewards working seniors far more than retiring seniors. You can keep contributing to retirement accounts well into your 70s. You get tax breaks for continued work. But the moment you retire, your benefits become taxable. Your withdrawals get taxed. Even your Social Security can be taxed depending on your income level. It's a system that quietly whispers, keep going. Don't stop. Not yet. And then came the most defining moment in modern retirement history, the COVID-19 pandemic. At first, millions of older workers left the workforce. Early headlines predicted a wave of early retirements. But then inflation hit, savings were eroded, housing costs jumped, and retirees were forced back into the labor market at rates that stunned economists. The dream of retirement faded again, this time even for those who had already achieved it. So ask yourself, is the U.S. encouraging later retirement for your benefit or for the system's survival? Because the next act of this story reveals something even more unsettling. There's a reason why the U.S. doesn't push policies that make early retirement easier, like subsidized healthcare for older workers, stronger pension protections, or automatic savings systems that remove risk from individuals. Other countries do it. The U.S. doesn't. Why? Because early retirement would expose a truth most politicians won't touch. The American economic engine is built on constant labor input, constant spending, and constant contribution. When too many people step off the treadmill at once, the machine breaks. And that sets up the question that drives the heart of this documentary. What happens when the generation that was promised everything ends up getting almost nothing? Mini cliffhanger, end of part 2. Here's where the story sharpens. To understand why the U.S. needs you working deep into old age, you have to look at the forces that shape the modern worker's life: the cost of living, corporate profitability, and a financial system built on perpetual motion. None of these forces stand still, and all three push against the idea of early retirement like a rising tide against a shrinking shoreline. Start with the cost of living. You've probably heard the phrase, "the dollar doesn't go as far as it used to." But the scale of that shift is staggering. Since the 1980s, wages for most Americans have barely nudged upward after inflation. Meanwhile, the core pillars of a stable life, housing, healthcare, education, have skyrocketed. A home that cost 2 or 3 years of income a generation ago now costs 5, 6, sometimes 10 years of income. Medical bills can blow through a family's savings in months, and higher education has turned into a decades-long debt sentence. So what happens when the essentials rise faster than wages? Retirement becomes a moving target. You may think you're saving enough, but every few years the finish line moves again. Inflation is the quiet villain in this story, chipping away at savings the way the ocean wears down rock. And the longer inflation keeps pressure on households, the further retirement drifts out of reach. But the system isn't just reacting to inflation, it's feeding off it. Corporations depend on continuous earnings growth to satisfy investors. That pressure trickles down to workers through productivity demands, wage suppression, and benefit cuts. Corporate America wants maximum output at minimal cost, and older workers, ironically, have become central to that formula. Why? Because experienced workers can do more with less training. They're less likely to job hop, and they often feel pressure to accept smaller raises or reduced benefits because they don't want to lose what little security they have left. For companies, that's gold. Older workers are stabilizers, reliable, predictable, and cheaper than many people expect. But wait, there's a deeper layer. When the U.S. shifted from pensions to 401ks, companies offloaded long-term financial risk onto individuals. That created a generation of workers whose retirement savings were tied to the stock market. And the stock market? It thrives when millions of Americans keep funneling money into it month after month. Early retirement slows the inflow. Later, retirement extends it. The longer you work, the more the system benefits. Think of it like a roller coaster that needs constant passengers to keep running. If too many people exit the line, the ride slows down. The entire economy, from Wall Street to Washington, is built on that ride staying in motion. Now let's talk about Medicare and healthcare, two areas where the financial incentives become even sharper. The U.S. has one of the most expensive medical systems in the world. Employers shoulder a big part of that cost for working-age adults. But when workers retire early, they shift onto Medicare sooner. And Medicare, unlike private insurance, is funded by taxpayers and federal budgets. The earlier people retire, the more strain Medicare faces. So, what does the system do? It keeps nudging the retirement age higher. It encourages longer work lives. And it prices health insurance in a way that makes early retirement nearly impossible without employer coverage. A 60-year-old in the private health market often faces premiums that rival a mortgage payment. That's not an accident, it's a barrier. Now consider this. The U.S. economy is entering a moment of historic transition. Millennials and Gen Xers are inheriting a system engineered for baby boomers. Bigger population, cheaper costs, higher growth. But as boomers retire, the weight shifts. Fewer workers, more retirees, and a shrinking ratio of contributors to beneficiaries. It's a demographic squeeze no amount of optimism can erase. And yet, the system continues to operate as if endless growth is guaranteed. Here's where the psychological pressure comes in. For years, Americans have been fed a powerful narrative. Retirement is your responsibility. If you struggle, you didn't save enough. You didn't work hard enough. You didn't plan well enough. But that idea hides a crucial truth. No amount of budgeting can solve a structural problem. When wages lag behind costs for decades, individuals can't fix it through discipline alone. When markets swing wildly, people can't force stability. When healthcare costs explode, you can't outsmart them with spreadsheets. And yet, the pressure stays on you, the worker, not the system. Now we're left with a society where millions feel guilty for not being able to retire, even though the economic math was stacked against them from the start. A society where working at 68 isn't a personal choice. It's a financial necessity. So here's the cliffhanger. If the system depends on people working longer, what happens when people physically can't? Because that breaking point is closer than most Americans realize, and the consequences could reshape the future of work in ways we're only beginning to understand. Mini cliffhanger, end of part 3. Here's where everything converges. The physical limits of the American workforce. Because you can push policy. You can push financial incentives. You can even push cultural messaging. But you can't push the human body forever. Across the country, the data paints a stark picture. Most Americans in their 60s already live with at least one chronic health condition. Many have 2 or 3. Decades of stress, long commutes, physically demanding jobs, and the rising cost of preventive care have taken their toll. And yet the economic system, one that quietly depends on older workers, keeps pushing the retirement age higher. But what happens when the workforce can no longer keep up with the demands placed upon it? Look at industries like manufacturing, construction, retail, transportation, fields where millions of older Americans still work. These jobs aren't just mentally taxing, they're physically punishing. You can't drive a truck 10 hours a day at 72. You can't lift boxes in a warehouse with aging joints. You can't climb scaffolding when your balance starts to slip. And when workers in these industries hit the wall, they often have nowhere to go. There's a brutal irony here. The people who physically can't keep working are often the ones who most desperately need the income and the benefits. But without savings, without pensions, and without affordable health care, they're forced into a corner. Work until you break, or retire into poverty. Now, zoom out. Think about the millions of Americans approaching retirement with less than $30,000 saved. Think about rising life expectancy colliding with stagnant wage growth. Think about the most expensive healthcare system in the developed world. The math doesn't add up, and the gap between what people need to retire and what the system is designed to provide keeps widening. This is where the U.S. faces a crossroads. Not a philosophical one, a numerical one. If older Americans can't work as long as the system needs them to, then 2 things happen, both serious. First, the labor force shrinks. Fewer workers mean fewer goods produced. fewer services delivered, and slower economic growth. Productivity drops. Companies feel it. Markets feel it. Second, the pressure on safety nets explodes. Social Security pays out more sooner. Medicare absorbs a flood of older adults with expensive medical needs. State and local programs get strained. And the federal budget, which already bends under the weight of entitlement programs, buckles even more. The U.S. has avoided this breaking point so far because generations have stepped up, often reluctantly, to keep working longer. But that patchwork approach isn't sustainable. At some point, the system hits a wall. And here's the twist. That wall is coming faster than expected. You can see the early cracks. Disability claims are rising. Workforce participation among older Americans wobbled after the pandemic, revealing how fragile the system is when even a fraction of seniors step back. Industries dependent on experienced workers are scrambling to fill roles. Companies are quietly rewriting policies to retain aging employees, not because it's generous, but because they simply can't afford to lose them. The U.S. economy isn't just influenced by older workers. It's increasingly held together by them. But here's the uncomfortable truth the title of this documentary points to. This dependence wasn't chosen by workers. It was built by decades of economic policy, corporate decisions, and cultural messaging that shifted risk away from institutions and onto individuals. Retirement used to be a promise. Then it became a plan. Now it's a moving finish line many Americans are told to chase until the very end of their working lives. So now the question becomes, what does the future look like? Do we redesign the retirement system, rebuild social protections, and reshape the labor market so people can step back with dignity? Or do we continue down the current path, one where retirement becomes a luxury reserved for the fortunate few, while everyone else is expected to keep working until their health gives out? As you sit with that question, remember this. Retirement was never meant to be a reward for the lucky. It was meant to be a closing chapter for everyone, the moment where decades of labor are met with the peace of a secure future. If that idea feels like it's slipping away, it's because the system has shifted so gradually, so quietly, that most Americans didn't notice. Until now. And if you've made it this far, here's your call to action. Subscribe to receive more reviews like this. Deep dives that cut through noise and reveal the forces shaping your financial future. Because understanding the system is the first step to changing it.